Welcome to the sixth week of the course Energy Economics and Policy. In this week, what we are going to do is that, we have looked into the energy demand and energy supply separately in previous weeks. And in this week, we will explore several market forms in order to understand what kind of market form actually suits the energy industry. So what is the form within which the energy market operates? The scheme of the presentation will be like this. So we will initially explore different theoretical forms of different types of market. This is at the very first place very important to understand the functioning of energy markets or for any markets per se. So as we have been doing it for demand as well as supply, for the market as well, we'll also explore the theoretical foundation, the economic foundation of different types of market, and then we will try to see how the energy market actually fits in a particular category. The first lecture you will see, we are going to start with the form which is perfect competition. Then we will move on to monopoly, and then we will also explore oligopoly. And interestingly, what we will see is that there is no one market form that suits the energy market as a whole. So if you look at the oil market, the dynamics, the market dynamics that is going on, that is very, very different from what is going on in, for example, natural gas market, or both of them, they're very different from what is going on in the electricity market, for example. So we will try to explore as many types of market form as possible and try to fit in the energy market within that. So let me just do a little bit of recapitulation in this week, and this was the agenda of our course. We said that we'll try to cover four different aspects of energy economics as well as policy, and all these aspects will actually revolve around some basic concepts in economics and policy making. So far, you can see we have covered the topic on energy as a resource. We have also covered energy demand in week 2 and 3. In the following 2 weeks, we covered energy supply, and today we have moved on to energy market. Now, if you want to read a little bit on this, you want to have more understanding and theoretical grounding, more examples, this book you can always follow. Even for the previous chapters, I have given the reference of this book. This is by Professor Subej Bhattacharya. The name of the book is Energy Economics, Concept, Issues, Market and Governance. This is a Springer publication, and for this particular area, energy market, you can look at chapter 12 and chapter 13. So when I say that we are going to cover market forms, we are actually going to cover three very basic types of markets. The first one is called perfect competition, the second one is monopoly, and the third one is oligopoly. So let us start with what do we understand by these three different types of market. But let me just give you the disclaimer here that these are not the only three forms of market. There are other forms of markets as well, but these are broadly used in analyzing the energy markets. The first one is perfect competition. The basic characteristic of a perfectly competitive market is that there are multiple number of, or there are infinite number of buyers as well as infinite number of sellers. In case of monopoly, the case is a little different. Although you have multiple buyers, there is only one seller of a particular product. Now you will understand and you will see that both this perfect competition as well as monopoly, they are sort of theoretical extremes. We do not really have markets of these forms existing, but when we see a market, we try to understand whether the particular form of market is actually tending towards perfect competition or is it tending towards monopoly. Or what are the problems of a particular market being perfectly competitive, or why a particular market is monopolistic in nature, or why there is oligopoly. So as I said, unlike perfect competition, in monopoly you have one producer as well as the supplier. However, you have multiple buyers in the market. So clearly you can understand that there is a lot of power that is enjoyed by the monopolist. In case of oligopoly, the buyer remains many. However, instead of one monopolistic farm, you have two or maybe three or four limited number of suppliers present in the market. So they do not enjoy the supreme power that the monopolists enjoy, but of course they have some command over the market, as some of them, only few of them, are actually dominating the market. Let us begin with perfect competition. For this, we start with the features of the perfectly competitive markets. So what are the primary features? The first one that we have already discussed, there are many buyers and there are many sellers as well. This is the first feature. The second one actually follows the first feature. Now you imagine a market where there are multiple buyers and multiple sellers. They are actually buying and selling the same quality of product or the same product in the market. None of them would actually have a command over the price. So if a particular seller is motivated to charge higher price than the rest of the sellers, then the buyer actually has a number of options to go for. So what at the end of the day, what will happen? The seller will lose the buyer, but nothing happens to the buyer. The market equilibrium doesn't change. So no producer will actually be encouraged to charge a price which is higher than the market price. And therefore we say that in the perfectly competitive market, the producers or the sellers, they are basically the price takers. So they cannot make the price, they take the market price that has been determined. Similarly, the buyers, they also do not have any control over the price. They are also the price takers. Because if there is one particular buyer who is willing to pay less amount of money for the same product, the seller will not actually sell this product to this particular customer. Why? Because there are other n number of customers to whom this particular product can be sold. So the price cannot be manipulated by either by the seller or by the buyer. Therefore, we say that both the buyer as well as the seller, they are the price takers in a perfectly competitive setup. However, in order to this thing operate, one very crucial assumption is that the product has to be homogeneous in nature. So everybody is selling the same quality of product. They cannot, be distinguished in terms of quality. Then the price can vary. The fourth feature that is documented here, we are saying that the firms can freely enter or exit the market in the long run without affecting the price. We will pay a little more attention to this in the future slides, but what it essentially means is that there are so many firms in the market that if some firms leave and some firm enters, it kind of creates an equilibrium through which the most efficient outcome can be generated. However, it may seem a little bit vague at this point, but we will look into this point in the coming slides. The fifth one, which is extremely important, and this says that the complete information is very, very important to be there in order to the perfectly competitive market exist. If there is information asymmetry, if there is lack of information with the buyer or with the seller, or if there is a mismatch between the information that is available with the buyer and with the seller, then the perfectly competitive structure actually breaks down. So this is one very important assumption and a very strong assumption, I would say, with the perfectly competitive market structure. Before we go into the functioning of perfectly competitive market structure, let us have a quick look at the cost functions that we had discussed in the previous weeks. We said the cost function is basically cost which is expressed as a function of output produced. So let me just use this. Okay, so C is a function of Q. So C is a function of output produced. And then we said that the cost can have two parts. There are two types of costs that we can think about. The first one is called a fixed cost. So fixed cost is that component of a cost which does not vary as you change the level of production. So this is not a direct function of Q. This is a lump sum kind of cost that you have to incur in order to undertake the production. However, as you increase or reduce your level of production, this cost is not going to change. For example, the cost that one has to incur in order to buy the machinery for production, for example, right? Or to set up the boiler, for example, or in the the drilling machines that one need in the oil fields. So this is kind of one-time investment that they have to undertake, and whether you produce or not, whether you produce higher quantity or not, this investment remains unchanged. So this is called the total fixed cost. The second part is called variable cost. Unlike fixed cost, in case of variable cost, if there is no production, then technically there will be no variable cost incurred. Again, you take the case of the power plant. Suppose you have installed the boilers there. However, if you want to produce electricity, what you need to buy coal. So that is the fuel that you need to buy. That is your raw material. So if you have to buy coal in order to produce something, and you have to buy more coal if you want to produce more power, right? So the cost on coal increases as you change the level of production of power. So therefore, the cost on coal is a variable cost. So this actually we have discussed before. So we come across two parts of cost. One is a fixed cost and the other is a variable cost. And then we also discussed several aspects of cost. We said that total cost is it has two components, as we have said, total fixed cost and total variable cost. Then we talked about average fixed cost. What is average fixed cost? This is the total fixed cost divided by the output produced, the level of output produced. Then we talked about average variable cost. This is the total variable cost that you are incurring in order to produce a particular level of output divided by that level of output. Then we have average cost, which is a sum of average fixed cost and average variable cost. Or you can also take it as total cost divided by the level of production. Finally, this is the very, very important concept in case of pricing in a market, which is the marginal cost. Marginal cost is the incremental cost that you have to bear when you increase your output by 1 unit. So in a discrete form, I have written it del Tc by del Q, or you can also write it as dTc dQ. So the change in total cost due to change in output. Now you can clearly see this will only be affected by the variable cost, because even if you change your level of output, that is not going to affect the total cost, the total fixed cost that you are incurring. So this is the change in total variable cost as you change your level of output, level of production. There might be a little bit of ambiguity to understand the difference between the average cost and marginal cost. So let me give you a quick example of a simile kind of a thing. So if you are watching a cricket match, right? If you are watching a cricket match and India has scored, for example, 60 runs in 10 overs. So the run rate is 6. So this run rate is similar to the concept of average cost. So this is the run rate is similar to average cost. Now what is marginal cost? Suppose in the 11th over, right, irrespective of the run rate being 6, in the 11th over, India scores 10 runs, right? So this 10 is the marginal run scored by India. So marginal is whatever is scored at the last over. Average is the average score over the entire over that has been played. Okay. The similar concept is valid in case of cost function as well, in case of the average cost and the marginal cost. So let us have a quick look at the shape of the cost functions. We will start with the average fixed cost. So if we plot the average fixed cost in cost quantity plane, what we essentially get is a rectangular hyperbola. Because if average fixed cost is multiplied by quantity, then what we get is total fixed cost, which is constant. The other observation is it's continuously declining. So initially you have made some investment. As you increase your production, your investment per unit of production or your fixed cost per unit of production is falling down. The second one is average variable cost, right? So this was upward rising. So we saw that up to this point, the productivity, the average productivity of the variable inputs, this increased. As a result, the average variable cost fell down, but after a point, the average variable cost started increasing as the average productivity of the variable factor starts declining. Then we come to the average cost. This is basically a sum of average fixed cost and average variable cost. In this diagram, if you look at this, basically what you are doing, you are vertically adding up this distance, this average fixed cost, plus the distance average variable cost in order to get this distance average cost. So it basically looks like this. So in order to get this line, what I am doing, I am adding this part, which is my average variable cost, with this part, which is my average fixed cost. So this difference by construction should be equivalent to this difference. Now see, for average cost curve, it initially declines because initially both average variable cost as well as average fixed cost, they are declining. So up to the the minimum point of AVC, there is no question that AC will decline because both the components are declining. After that, one component keeps on declining, that is average fixed cost. However, the other component starts increasing, which is the average variable cost. So two components are actually moving in two opposite directions. Now the question is, what happens to the average cost curve? Initially, the average cost declines. This is dominated by the decline in the average fixed cost curve. However, after a point of time, the dominance goes in the part of average variable cost, and you can see that after this point probably the average cost starts rising because the influence is more influence on average cost is more by the average variable cost. However, what we actually get is the U-shaped average cost curve. The final one is the marginal cost curve. This also we had an explanation. This is again U-shaped. Its upward rising part actually cuts the AFC, AVC and AC from below. And we also saw that it cuts the average variable cost and average cost at the minimum point of both the curves respectively. So this is how the cost functions look like. And this structure of the cost function actually has a lot of implication when we talk about the pricing in a market mechanism. So what happens in case of perfect competition in the short run? So why are we saying short run? Because in the short run, you have some fixed input. You can't you can't change your fixed input. However, in the long run, you can change all your fixed inputs. What is the objective of the producer? The objective of the producer is to maximize profit. The profit is given by total revenue minus total cost. We can break it up if you want to. You can break it up, this total cost, as total fixed cost and total variable cost. However, that's not really needed for this kind of a derivation. Then you see that this we are writing total revenue is equal to P multiplied by Q minus CQ. Now this CQ is very clear. CQ is the cost function. So instead of writing total cost, we are writing CQ. We are writing total revenue as PQ. So as I write PQ, I make it sure that P is not a function of Q. So P is a fixed number which is given from the outside. Now if you can recall the concept of perfect competition, we started by stating that the number of buyers and the number of sellers are so big that none of them can actually influence the market price. So all of them are price takers. Therefore, price is a variable which cannot be influenced or which cannot be changed even if you undertake the profit maximizing behavior, right? So P is a constant which is given from the outside to a perfectly competitive market, or to a producer in the perfectly competitive market. So in order to maximize the profit, the first order condition is del pi del q is equal to 0. You can also write it d pi dq as to be equal to 0. I mean, because there is only one variable here. Now, when I write d pi dq, again I am emphasizing on the fact that q is the only choice variable that the producer has. So q is the only variable that the producer can choose in order to maximize the profit and not p. If I derive the first order condition, what do I get? So this is the first part, dpq dq minus dcq dq. This has to be set to be equal to 0. Now if I take the derivative of pq, I am taking the derivative of pq in terms of q. So what I am getting? I am getting p here because q, I'm taking p out, and therefore I have dq dq which is equal to 1. Minus what do I have? I have dcq dq. So this is the increase in my cost as I increase my production. So this is definitely the marginal cost of my production. So the first order condition actually states me that price minus marginal cost to be equal to 0. That is, price should be equal to marginal cost. So in order to maximize the profit, what the producer or the supplier in the perfectly competitive market has to do is to equate the price given by the market with the marginal cost. So this is the first order condition. What is second order condition? The second order condition will actually say that d2 pi dq2 is negative because we are maximizing. Now if I want to put d2 pi dq2 equal to negative is negative, that means dp dq, which is 0, right, which is 0, minus dmc dq, that has to be negative. So basically minus dmc dq has to be negative. If I take the minus sign out, this means dmc dq is positive. dmc dq positive means that the slope of the marginal cost curve has to be positive. So that again means as you increase the quantity produced, the marginal cost should be rising. So it simply means that your profit maximizing output should be on the upward rising part of the marginal cost curve. Now this is the marginal cost curve. This is how it looked like. Now what does profit maximization mean? The profit maximization to a perfectly competitive farm means if the market determined price is at P equal to P naught, then this individual supplier should supply Q equal to Q naught, because this is where this guy is equating P with the marginal cost. So this is nothing but the marginal cost curve of the farm. Okay. So it's equating P equal to MC and therefore determining the quantity that needs to be produced. Similarly, if P is equal to P1, then the producer will produce and supply Q equal to Q1 in the market. This will go on until the shutdown point. This again we had discussed. I'm not going to the details. This is the minimum point of the ABC where the MC cuts ABC from below. So you can see this dashed part of the marginal cost curve is basically the supply curve of a perfectly competitive market. Supply curve of not a perfectly competitive market, but the supply curve of a single producer in a perfectly competitive market. So each producer in a perfectly competitive market will have an upward rising supply curve, which is basically their upward rising part of marginal cost curve over and above the shutdown point. Okay. So this is the first characteristic that we have understood about the perfectly competitive market. Now let us see what is the profit that the perfectly competitive firm will earn in the short run. Now what is profit? We have already discussed that profit is basically total revenue minus total cost. Okay. So total revenue minus total cost. And what is total revenue? Total revenue is price multiplied by quantity. And what is total cost? Total cost, you can think about total cost as average cost multiplied by output produced. Okay. So total cost, you can think about total cost as average cost multiplied by quantity produced. Okay. If that is clear, then we can identify the profit very quickly. Now there is a disclaimer that I want to put forward before we enter into the discussion on profit. What the entrepreneur receives in the process of production is also often called the profit. However, this profit is actually a normal profit, and this profit is a part of the cost. So when the cost of production is calculated, the payment to the entrepreneur is also calculated as a normal profit. So it is not the fact that the profit that we are defining by total revenue minus total cost, that is the part of profit that accrues to the entrepreneur. It's not that case. This total revenue minus total cost, this is actually, we are talking about the supernormal profit. And here what we are going to identify whether or when the farm in a competitive market actually earns supernormal profit. Suppose the price is equal to P1. Okay. So I have constructed P1 in a little clever manner so that you see that P1 actually intersects with MC at the minimum point of average cost curve. However, if P is equal to P1, then the quantity supplied will be Q1 by this farm. Okay. So what is the revenue earned by the farm? The revenue earned by this farm will be O P1 A Q1. So this is the total revenue. Now interestingly, If price is equal to P1, what is the total cost of the farm? We have said that the total cost can be conceptualized as the average cost multiplied by the quantity produced. Now see what is the average cost here? Here the average cost is equal to the price. Since the average cost is equal to the price, the total revenue is actually equal to the total cost. So here the farm neither earns any supernormal profit nor is there any supernormal loss. So the farm operates at normal profit and this is called a break-even point. Okay. So this way, this point A or this price P1 is a very unique price where the farm actually breaks even, where the total revenue is equal to the total cost, just the desired kind of situation. However, if the price is higher than P1, then what happens? If the price is higher than P1, suppose P2, then the producer will equate P with MC at point B. If that is the case, then the output produced will be Q2. Now, if Q2 is the amount of output produced, then both total revenue as well as total cost are going to change. Now, what is the total revenue that I am getting now? The total revenue that I am getting O, P2, B, Q2. So, the total revenue is, let me repeat, O, P2, B, Q2. This total rectangular area, correct? Now, what is my total cost? Total cost is equal to, remember, it's average cost multiplied by the quantity produced. So, what is the average cost if I am producing Q2 amount of output? The average cost is this much. It's here. Here is my average cost. So, if I multiply this height with Q2, I should get the total cost. And then I will see that the difference between the price and average cost is actually this distance marked by red here. This is the distance between the price and average cost. So the price is higher than average cost by this amount per unit. If that is the case, then what is the total supernormal profit that I am earning? So what is my TR, total revenue minus total cost? This shaded area is actually my total revenue minus total cost. So this actually captures this. What does this area capture? This captures P minus, so you see this captures P2 minus average cost at Q2 multiplied by Q2. So this is the supernormal profit that you have. Now the question is, in a competitive market structure, how can a farm have supernormal profit? Because it is not a price maker. However, there can be multiple sources of supernormal profit. The first of all, some farms may be, more innovative in nature. They may invest more in innovation, and the innovation may pay some return. Similarly, the return can be from risk and uncertainty bearing. So you take some risk and you gain some return. There can be some windfall gains, there can be some unexpected market situation, and so on. So these are the things that can lead to a supernormal profit in case of perfectly competitive market structure. One more thing that happens, once the existing firms in the competitive market actually starts earning the supernormal profit, the other firms gets attracted to that and they want to enter the market. So as we move on to the discussion on the long run supply curve of the farm, we will see that existence of supernormal profit actually encourages more farm to enter the market. Suppose this is the situation. This is actually P. Earlier we were calling it P2, now we are calling it P1. Suppose this is 20 and at this price, this is one of the existing farms, it's earning a supernormal profit. Why supernormal profit? Because you see that the average cost is actually lower than the price. So this farm is earning supernormal profit. As this farm is earning the supernormal profit, other farms are interested in this industry, interested in this market. So what do they do now? They start entering into the market. Now, as more farms enter into the market, their supply increases while the demand remains unchanged. This situation actually leads to a decline in price. So this is a very common phenomenon. Whenever there is oversupply of something in the market, with demand remaining unchanged, the price falls. Suppose the price falls, and we know that these farms are price takers. I mean, they have to take the price that is determined in the market through the interaction of the aggregate demand and supply. So suppose the price declines and the price reaches at P2. Once the price reaches at P2, the same farm now will reduce the production, and the production will come down to Q2. Now, once the production comes down to Q2, the farm will start earning or not earning, the farm will start experiencing some kind of a supernormal loss. Now, why is there a loss that we are talking about? The loss is because of the fact, see, if you are operating at this point, if this is your point of operation, what is happening here? Your cost, this is the average cost, your average cost is actually higher than the price that you are charging in the market. Therefore, your total revenue is falling short of your total revenue is falling short of your total cost. So you are unable to recover the total cost that you have incurred in order to produce Q2. Now, this will actually drive some of the inefficient farms out of the market. Once the inefficient farms are going out of the market, the supply will reduce and the price will again slowly see some kind of an upward trend. So this dynamics actually goes on in a perfectly competitive market in the long run, and finally the perfectly competitive market settles down at a price where those farms will exist who will operate at their minimum, minimum point of their average cost curve. So in the long run, what is shown here is that P star is the long run perfectly competitive price where all the existing farms, the farms those who are existing, they are actually operating at the minimum point of average cost curve. So none of them, you can see, they are all at the minimum point of average cost curve. None of them is earning a supernormal profit. None of them are incurring any kind of loss. So it's a no profit, no loss kind of a situation under which the long run perfectly competitive market equilibrium operates. And this is the most efficient outcome. Okay, so now we are going to discuss about the working of the perfectly competitive market through this example. So suppose there is a producer in the perfectly competitive market where the cost function in the short run for this particular producer is given as CQ, which is 64 plus Q square. Now, if you look at this cost function, one thing which will be clearly evident at the very first glance, that this 64 is irrespective of the quantity, right? So this is the fixed cost. However, this Q square part, this keeps on changing as you keep on changing your production. So this is the variable cost component. The questions that we have here, what are the short run average cost, short run average variable cost, and short run average marginal cost, short run marginal cost? And the question also follows that if the price of the product is rupees 32, so you see that the price is given from the outside. This is that the supplier has no control over the price. What would be the optimum level of production? What is the profit of this particular farm? So let us have a quick look at the mathematics of the problem. So this is the cost function that is given. CQ is equal to 64 plus Q square. So the total fixed cost, as I have just mentioned, is 64 and total variable cost is Q square. Now this 64 is actually scaled down in some particular measure. It doesn't mean that it's 64 rupees. What is average fixed cost? Average fixed cost is the total fixed cost divided by the quantity produced. So that is 64 divided by Q, and then you have average variable cost, which is Q square divided by Q. So here you have Q square divided by Q, so that what you get is Q here. So the average cost is a sum of average fixed cost and average variable cost, which is 64 divided by Q plus Q. And the marginal cost is given by 2Q that I am getting by taking the derivative of total variable cost in terms of Q. So this marginal cost is actually what I am getting from here. I am taking a derivative. So what I am doing is that, what I am taking is del Q square or dQ square dQ. Okay. So pardon me for this erratic writing, but this is how I'm getting the marginal cost as 2Q. So the profit maximization, as we have seen, that the first order condition of profit maximization is P equal to MC. So because the price is given to the producer as 32, all the producer has to do is to equate this 32 with the marginal cost that it has. And here if it equates the marginal cost with 32, it should produce Q equal to 16. So Q equal to 16 gives the optimum level of output, because 32 should be equated with 2Q. So 16 is the optimum level of production. So what is the price and quantity solution for this particular producer in the market? The price is 32 given by the market, and the quantity it produces is 16. Now recall one thing, that this is the share, this is the market share, or this is the share that this particular farm is actually producing and supplying in the market. This is not the market outcome. In the market, there are multiple producers like this person, and they are supplying their own product as well. So this 16 actually stands for the output produced by this particular farm. Now the next question that we had is, what is the profit? Now in order to calculate the profit, we need the total revenue as well as we need the total cost. Also what we can do, actually, if we go back in the previous, right, in this slide, if you can actually remember that how did we calculate the supernormal profit? The supernormal profit was actually the average cost. So this is the average cost, P minus average cost multiplied by the quantity produced. That is what was giving me the total revenue minus total cost in a sense. So here also we are going to do it in the same way. So if I come back here, you see the average cost at Q equal to 16 is actually 64 divided by 16 plus 16. So 64 divided by 16 is the average fixed cost, and 16 is the average variable cost. So the average cost at Q equal to 16 is 20. Now this is less than the price that is being charged in the market. So to produce 1 unit of output, this farm has to bear the cost of 20 rupees, for example, and it's selling the same product at 32 rupees. So per unit there is a supernormal profit of 12 rupees, and this guy is earning this 12 rupees of supernormal profit for 16 units. So the total profit that this guy is actually getting is 192. So in this scenario, we can say that this firm is actually earning a supernormal profit in the short run, which in the long run is going to attract more firms to enter the market, and therefore the price is going to reduce a bit. So this is what we can conclude from here, and this is how the equilibrium in the perfectly competitive market looks like. So if we juxtapose the same the numbers on the diagram that we are familiar with, we can see that this is 32, right? This is 32, this is 20, and this is the difference between 32 and 20, and this is multiplied by 16, and therefore you are getting a supernormal profit which is of 192. Okay, so this is how it looks like in the diagram. So far we have talked about the supply curve of the farm. So what happens to the supply curve of the market itself? So what happens to the supply curve of industry? How does it look like for a perfectly competitive market? Because that is again going to have a big implication in terms of price mechanism. So suppose this is the first the supply curve of the first farm, this is the supply curve of the second farm. What happens if we join them together? What happens if both the farms are supplying in the market? It happens in this way. So as we said that the farms are price taker, and suppose the price is somehow set at rupees 32 per unit of per unit of the product. So how much will be the aggregate supply in the market? See, the first farm is supplying Q1 amount of output. In optimum, the first farm will supply Q1 amount of output if the price is equal to 32. The second farm will supply Q2 amount of output if the price is 32. Therefore, in the market, the industry, if they comprise of these two farms only, they are going to supply Q1 plus Q2 amount of output. So this is going to be the industry supply curve. Now, what is important to observe is this. The industry supply curve is actually flatter than the individual farm's supply curve. Why? Because you are adding up the individual farm supply curve horizontally in order to get the market supply curve in the perfectly competitive market. So in this way, if you keep on adding more farms one after the other, this aggregate supply curve will become flatter and flatter. If your aggregate supply curve becomes flatter and flatter, if you actually have infinite, very large number of farms, what happens? It will become flatter like this, it will become even more flatter, and after a point of time, you will see that this horizontal line at p equal to 32 becomes, which is the flattest possible option for the aggregate supply curve to be, this becomes the market supply curve of this particular product. Therefore, the market supply curve of a particular product in the perfectly competitive market is basically a horizontal line at a particular price. So whatever will be demanded will finally be supplied, but the market has the capability to produce any amount of output at a particular price because there are n number of producers in the market. So this is the dynamics of the perfectly competitive market. We will take up one more example and then we move on to see what happens in the energy markets. Are the features of energy market suitable for being perfectly competitive or not? So in this example, what we are saying is that there are two farms which are producing and supplying in the market. The marginal cost curve of these farms are given by MC1Q1 and MC2Q2. Now you can see that when I am mentioning about the marginal cost curves, they are also the supply curve of the farms, right? The supply curve of the first farm is given by P equal to, so P is being equated with marginal cost. So the supply curve of the first farm will be P equal to Q1 plus 10, and the marginal the supply curve of the second farm is going to be P equal to marginal cost of the second farm, which is equal to 0.8 Q2 plus 14. Now, if the price is equal to 20, then what is the market output? That is the question. So nobody is asking what is the price outcome because that is already given. The question is what is going to be the market output and how much each farm is going to produce. Now this is very easy to solve. If you remember this diagram, each farm is actually equating the market price with their marginal cost. Each farm is equating the market price with their marginal cost. Whatever they are producing individually, that is being added up and supplied in the market at the same price. So here we will do the same, we'll address the problem in the similar manner. If you at equilibrium, if you equate P with MC1, then what you get is, see your P is 20, you get 20 is equal to Q1 plus 10, right? So this Q1 plus 10 is being plugged here, right? From here you can quickly solve it that your Q1 is equal to 10. So the first farm will be producing 10 units of output. For the second farm you are equating 20 with 0.8 Q2 plus 14. You are getting this from here, okay? See, you are getting it from here, you solve for Q2 and then you get Q2 is equal to 20 minus 14 divided by 0.8, which is equal to 7.5. So what is the total industry output? The industry output is 10 plus 7.5. So the industry output is 17.5. The market price remains 20. And this is the distribution of the production among both the farms. So this is how the market share of each of the farm can be determined in a perfectly competitive market. This is just for the sake of completeness. We are really not going to use this particular, this kind of exercise in the energy market, but this is just for the sake of completeness to understand what is the mechanism of a perfectly competitive market. So we are going to stop here. In the next lecture, what we will do, we'll take up the case of energy market and see whether that will suit the perfectly competitive market structure or not.